There is a feeling I get when I stare at a chart long enough that it starts to feel less like numbers and more like a heartbeat, a rhythm that repeats itself no matter how much time passes, no matter how much we think we have changed. And right now, looking at Bitcoin, I am observing that cycle play out once again, as familiar structural patterns emerge in the price action. In previous bear market cycles, we watched falling wedge structures carve themselves into the chart, slow, patient, and persistent. And now, within this current corrective phase, a similar consolidation structure is forming. History rarely repeats identically in financial markets, but macro liquidity cycles frequently echo familiar technical structures. Welcome back to Crypto 101 Central. I'm Alex. Before we dive deeper into the technical data and market sentiment, if you are new here, please take a moment to subscribe to the channel. It genuinely helps this analytical community grow. And click that notification bell so you stay fully informed as this cycle unfolds. Let's examine the shorter timeframes together, because this is where market tension and momentum collide. Bitcoin recently found a short-term bounce off a key historical support level, a zone we have monitored closely as a structural baseline. While price action pushed above a short-term downward trend line, volume and momentum metrics indicate that this initial move lacks aggressive institutional backing. It remains plausible for Bitcoin to experience a minor relief rally toward higher overhead resistance levels to sweep near-term liquidity. However, such a move would still align with broader macro consolidation, rather than confirming an immediate structural trend reversal. Caution remains warranted, because underlying market indicators suggest potential downside risks before a definitive floor is established. We are currently observing a localized upward sloping channel, but if selling pressure resumes, a break below this trend line could trigger a final liquidity sweep to clear out remaining over-leveraged long positions. Funding rates across major derivatives exchanges have shown temporary spikes during periods of sideways price compression. Historically, high funding rates during low volatility phases suggest built-up leverage, which often acts as a magnet for market sweeps targeting liquidity below current price levels. Volatility measures remain near macro lows. Extended periods of low volatility in digital assets rarely persist indefinitely. They typically resolve with substantial directional expansion. Meanwhile, traditional equity markets have continued to show resilience, creating a temporary divergence with digital asset price action. This decoupling is not unprecedented. During historical market cycles, equities and crypto assets have occasionally diverged for extended periods before macro liquidity forces realign them. Either broader market corrections bring assets into closer alignment, or digital assets experience a rapid catch-up phase during subsequent expansionary cycles. From a timing perspective, historical seasonal patterns often present choppy or subdued market conditions during late summer and early autumn. Furthermore, stablecoin liquidity metrics indicate a temporary slowdown in capital inflows into the space. Taking a step back to the macro timeframe, the overall structural narrative remains intact. If a final corrective leg occurs, price action would still remain well within the macro boundary of the long-term falling wedge pattern, potentially retesting key historical support zones established during prior accumulation phases. From a technical standpoint, a decisive high-volume breakout above major multi-month downtrending resistance has historically marked the transition from cycle bottoms into new long-term expansionary trends. In terms of portfolio management and risk mitigation, maintaining discipline is key. High-leverage strategies require patience, waiting for clear confirmation of market capitulation or structural breakout before deployment. For long-term allocation, dollar cost averaging around macro baseline indicators, such as historical multi-year moving averages and significant drawdown levels, has historically provided favorable entry zones for multi-year horizons. As we navigate the remainder of this market cycle, our analysis will increasingly focus on preparing for the structural shift toward the next expansionary phase. Just as we highlighted risk management and downside targets throughout the corrective phase, identifying early signals of accumulation and long-term positioning remains essential. If today's analysis helped you navigate these market dynamics with greater clarity, please hit that like button, subscribe, and click the notification bell. Leave a comment below with your thoughts on these macro targets and structural patterns. Thank you for watching, stay disciplined, and I will see you in the next update.